Hello, welcome European listeners and market participants, and welcome to KBRA's latest European Credit Podcast. I'm Gordon Kerr, Head of European Research at KBRA, and today I'm joined by my colleagues across our ratings teams to take you through our experience of the recent securitization event called Global ABS. Celebrating a return to Barcelona post-pandemic, the Global ABS 2022 conference attracted a record nearly 4,500 registered attendees and a very packed program featuring several keynote addresses and nearly 40 panel sessions. Global ABS is the largest annual European structured finance conference and is hosted by both AFME, the Association for Financial Markets in Europe, and IMN, Information Management Network. Despite only 8 months since the previous gathering, the 2022 event comes at a very different time and with a very different feel to the European securitization markets. We did a survey, which is published on kbra.com ahead of the event. And overall, there was a feeling amongst the survey participant that things were going to get worse before they got better. I'm going to begin by asking my colleague Yee Cent Wong, who is co-head of Europe, about the overall feeling. You sat in on meetings across products and with investors. What is your general feeling about the tone of the securitization markets as we head through what is expected to be a really difficult period with inflation and interest rate rises? As I mentioned, the survey suggests that we could be in for a really quiet primary market and continued spread widening. Do you agree that this holds true across the market?
Hey, Gordon, thanks. The general feeling is that the market does face challenges in the short term. Issuers, investors, and other market participants that we met with were generally more cautious and less optimistic than the prior Global ABS conference. Pressure is expected across all sectors, although some sectors are expected to weather the storm better than others. More pressure is expected on NPLs, which had already been impacted by the pandemic. On the other hand, the outlook on future performance for trade receivables were generally viewed positively given the resilience shown through COVID and recent economic pressures. SME and corporate defaults are expected to rise, with rating migrations and defaults expected for CLOs. Auto defaults are also expected to increase, with recent emerging non-prime transactions considered to be more vulnerable. However, residual values have held up well, and new car sales are down. RMBS delinquencies are expected to be on the rise as well, with house price growth expected to moderate or become marginally negative in some areas due to rising rates and high inflation affecting affordability and demand for properties. But higher household savings and government support to counter rising energy prices are expected to cushion the blow. Also, the past decade has seen tighter affordability criteria for mortgage originations. CMBS was one of the first to see significant setbacks in primary market issuance, but the recent spike in bond yields is viewed to be owing to market volatility rather than credit-driven, with the number of loans entering special servicing expected to be limited due to low leverage. In terms of primary market activity, it has slowed since the end of February, with market participants appearing to be more selective. As such, issuance is expected to remain muted for the next few months. We're hearing that the private market is a little more immune to spread widening than the public markets. Market participants are generally bearish in the short term, believing that spreads will continue to gap out, but there are also hopes of a return to more stable conditions by the fourth quarter.
Thank you very much. That was a very comprehensive overview. Now, turning to my colleague, Kali Sirugudi, who heads up our European RMBS. Kali, many in the market have concerns about the performance of borrowers as the cost of living increases. What did you take away from your conversations with issuers and investors about their expectations for future performance? Do you agree with them?
Thank you, Gordon. The consensus at the conference has been an expectation of increase in delinquencies and eventual defaults as regards the outstanding mortgages in Europe and UK are concerned. This is driven by the current scenario where consumers are facing the high cost of living, high inflation, and on the other hand, you have the action by central banks to increase interest rates. Now, these factors affect mortgage affordability adversely. While in this scenario, delinquencies are expected to increase, any spike in defaults is at least 18 to 24 months away as servicers and lenders prioritize forbearance measures or alternate repayment arrangements over foreclosure to be able to deal with the increase in delinquencies. The increase in delinquencies are expected particularly for certain cohorts of the outstanding mortgages. Those mortgages paying a variable rate of interest could be more susceptible to delinquencies. Loans in reperforming or seasoned non-conforming portfolios where borrowers have shown historical financial stress. High loan-to-value loans to first-time buyers and borrowers currently in the vulnerable category. Having said that, there is a mix of factors in the current scenario which can mean that any high level of delinquency scenario is mitigated. Firstly, you have consumers who have built up savings over the COVID period. Secondly, the originations in the last decade have been under stricter criteria, particularly around affordability. Third, the unemployment levels across jurisdictions, barring a few, is at low levels. And lastly, the debt-to-income ratio for outstanding mortgages is lower than what was observed pre-global financial crisis. And if you look at then, if delinquencies do rise, then RMBS structures do have features to be able to absorb this kind of stress in the form of a reserve funds or a liquidity facility where available. Certain structures have interest rate caps, which have a payoff for the issuer in the event of a rise in interest rates. And another feature specific to Irish RMBS, you see provisioning for arrears and defaults, which help trap excess spread, which then means that you're able to pay down the notes quicker. So a clutch of these kind of structural features in RMBS issuance means that increase in delinquencies can be mitigated to a degree so that you're able to meet the liabilities as per the terms and conditions of the notes. On a different note, Gordon, there has been a fair bit of discussion and talk around ESG in RMBS. There is capital on the sidelines waiting for suitable labels on RMBS issuance. The key challenge which I gleaned from those discussions was to come up with an ESG score, which helps quantify the social impact of lending, exposure to properties lent against, where climate risk exposure is meaningful, or a quantifying carbon reduction, where lending is to properties which are energy efficient relative to others which are not. And there is also hesitancy to issuance, where there are concerns around greenwashing, and the issuance with the green or the social label in recent times in UK has not led to any meaningful reduction in the cost of funds by issuing paper in the securitization market. So that seems to be the flavor of the discussions as regards ESG in RMBS. Back to you, Gordon.
Thank you very much, Kali. Now, turning to structured credit, Gabriele, we published a new research piece by KBRA on mapping CLO manager styles by using cross-metric comparisons. Speaking to both investors and issuers and CLO managers, how was that received across the market?
Thanks, Gordon. KBRA has published a report on European CLO manager style. As you say, that was at the time of the conference in Barcelona. So this report really aimed to hopefully offer a different perspective on portfolio manager strategy. And again, this is not a ranking. So the idea is really to create a report came from a discussion that we had at the previous global ABS conference with some investors. So what we do in this report is we examine cross-metric comparison that could offer insight on potential strategy employed across the market and is expected to be updated on a quarterly basis. So what we have done is using various pairings of CLO performance metrics, a particular CLO manager platform can be assessed on where it may fall on the spectrum of conservative versus opportunistic approaches to portfolio management. Ultimately, we wanted to provide more insight on the different managers, providing additional analysis and show the overreaching pictures, not just some black and white results. The idea is really to present a more nuanced pictures of manager strategies And the feedback that we had so far is that managers broadly agree with our funding. So let's say we had some positive feedbacks. Effectively, an individual manager style or approach to investing in a pool of leveraged loan can vary compared to peers, in fact. In the end, it is investors who determine which manager's approach best suits their needs. So quantitative factor to assess manager, however, is not enough. And we heard from one of the panel discussion focused on manager tiering that performance is also assessed based on qualitative factor such as team composition, team churn, resources, investment focus, and ethos. Sometimes this is elements that are given significant consideration as well. The panelists also shared their view on new manager entrants, including US CLO managers in the European market. Why all were positive on new entrants, noting that it would bring diversification and innovation, they say that new managers face challenges to establishing market position, and they struggle to find equity investment for their CLO. And obviously another element is sourcing loans in the secondary market that could be tricky, and obviously building a credible team with relevant experience that can differentiate themselves and build long-term relationship in a relatively saturated manager market.
Thank you very much, Gabriele. Over the past several years, the CLO market has been a key pillar of the securitization issuance. However, with the current market change, what was the general feeling about the prospects for the new issuance markets? Are there expectations for some what are referred to as print and sprint style of transactions?
Yeah, so I had the pleasure to moderate the CLO Investor Roundtable, and that gave me really the opportunity to test current issuance expectation from an investor point of view. Investor, by the way, from different parts of the capital stack. So from the AAA investor all the way down to the equity investor. So what it was noted is that generally speaking, the 2022 so far has been challenging in terms of new issuance. The main theme have been the high inflation expectation, central bank hawkishness, recession fears. These have all impacted CLO. We see also, an additional issue being limited primary loan supply. On the liability side, we have seen much more volatility with spreads that have widened and AAA investors that are much more cautious given the volatility. I think investor expectation is for more rating migration, increases in triple C buckets, rising default rate in a generally more volatile market. In terms of approach, I think the panel noted that investors are being more conservative and they are actively engaging with the CLO manager to determine how prepared they are to navigate the current market. As you mentioned, one of the alternatives, but as one of the characteristic that we have seen in the last few weeks has been some print and sprint CLOs. Some of the investors, however, expressed some concern about the risks inherent in this approach. It's interesting, we had some diverging views within the panel from different investors, some with some negative tone. They say that print and sprint deals actually aren't a sign of a healthy market. So that was the comment of one panelist, adding that although they are seen as a sort of an opportunistic trade in the US, in Europe they are sort of a desperate play, saying that the portfolio in this deal wouldn't be necessarily of the same quality as usual, as manager won't be able to ramp the way they might like. But again, another investor say, if it offers good relative value, it might be worth considering. So effectively, investment decision would ultimately be made based on the value offer, as some other investors say. For EU versus US CLO, the preference was towards investing in the US market due to economic factors, as well as it being, as usual, a deeper and more diverse market. However, in terms of CLOs versus other asset classes, the panel noted that CLOs still offer a great value. We also discussed in the end about ESG. It was noted that there is no definition yet of an ESG CLO, but that best practice are being developed, and there is a move to do more than simply rely on negative screening criteria in terms of ESG classification. And ultimately, the panelists noted that Alpha is working to facilitate information flow from underlying borrowers to CLO investors, including ESG information, and a standardized due diligence questionnaire is being piloted with certain CLO manager. So it is hoped that more progress will be made in this area over the next year.
Great. Thank you very much, Gabriele. So turning to the ABS world, Kilian, you spoke on the solar ABS panel at the conference. What do you see as the prospects for that market?
Thanks, Emil, Gordon. I think it was a very interesting panel because we walked through the where, what, how, and why. And I think in terms of what we've seen, particularly from the US market across the pond, where KBRA ourselves have been very active in this market, having rated 57 deals totaling 15 billion, 38 of those in solar loan and 19 in solar lease, and a further 4.5 in private deals. I think we see what the opportunity in this market space is. Clearly, European institutions are driving this as well. And if one looks at their kind of gigabit target for solar energy, and particularly residential solar energy across Europe, I think it shows what the potential in this market is. So in terms of what the opportunity is, I think it's very significant, and the panel agreed with that. We then moved on to talk about the challenges of this market, of which there are numerous, and that's right across the European market, whether it be different regulations, different incentive packages in different jurisdictions. So certainly in terms of the European regulatory and legal space, it's very fragmented, and that does play into, I suppose, building volume ultimately for a deal. Clearly, and this was the experience that KBRA had in the US in the first instance, was appropriating appropriate proxy data for estimating how the SME/consumer will perform. So these are the challenges that issuers faced. And the panel then kind of moved on to, well, what are we actually seeing in the market? And what we're seeing is that certain portfolios and certain jurisdictions are very much ramping quickly at the moment, particularly in Spain and Germany. Even ourselves on a kind of reverse inquiry basis are seeing a lot more activity. We ran a webinar about a year ago, and I predicted that we'd see a public deal in the next year. I think I can confidently say at this point that we will expect to see a deal in the more near term. But then the discussion pivoted to the kind of the value proposition, which underlines the opportunity in this asset class. And I think the challenge with the value proposition, i.e. doesn't make sense for the consumer, is on one hand, you've got rising rates, but at the other hand, you've obviously got dramatically increasing energy prices. So that's which is good for solar loans. And certain issuers explain that the payoff period on these loans is actually shortening despite the rate increases at the moment. So I think, albeit it is a very challenged environment in terms of inflation, interest rates, etc., the value proposition that solar panels offer, and also the kind of the positive feel that they bring, I think will lead to further increases in obviously solar panels across Europe. And hopefully that will lead to a burgeoning ABS market. When we did ask the panelists about their expectations on the deals, I think the overlying kind of message from the panel was, there's a lot of stuff happening in the warehouse space. And given the volume increases that certain issuers are seeing to date, they would expect to see more activity in the public space in the near to midterm. So all in all, I think a big opportunity and certainly some positive momentum on the ground from what we're hearing as well.
It's great to hear potential for growth in that space. And I think something that everybody's looking forward to or hoping that will come to the securitization market. Of course, the ABS world is a hodgepodge of various asset types, I should say. Based on your conversations over the course of the conference, are there any other areas of the market that are likely to emerge with new types of collateral?
Yeah, I think it kind of echoes what Yee mentioned earlier about kind of everything being dominated by macroeconomic trends, particularly in the more typical ABS classes. But I think what we are seeing is continued interest in esoteric asset classes. Certainly, there's a lot of discussion around mobility solutions. So moving away from the classic auto loan to more subscription, fleet-based financing, and also different type of vehicles. Clearly, battery electric vehicles are becoming a much more present part of the market. So a lot of discussion around that. And then, receivables-based finance, whether it be in the insured space or in the trade finance space, we're getting a lot of inquiries about that. Across the royalty chain, I think this is, again, something that we're catching up on the US on. There's a lot more discussion about kind of royalty-based financing. So a number, and clearly, I've obviously mentioned solar, but that dominates a lot of agenda. ESG friendly asset classes, NPL will continue to be a discussion point. So yeah, a lot of conversations went a lot of ways. And I think there's a lot of new age asset classes that we're being talked about and be looking at. So it's certainly a dynamic time for the esoteric space. I think, in the more kind of the granular assets, or the more typical assets with rate rising, as you mentioned earlier, it's probably going to see a little bit of a tapering in the near term. But, hopefully that the market as a whole, and certainly the very positive momentum that the conference brought, will bring forward to kind of issuance in the medium term.
Great. Thank you. So hopefully some positive growth in terms of new opportunities. Sounds interesting. Now, turning to the commercial mortgage market, last but not least, Stephen Hughes, one of the most impacted markets by the current disruption was the CMBS market. Do you think this is justified? And does it feel like there are issuers looking to return to the market once it has stabilized?
Well, thanks, Gordon. As the most concentrated asset class in structured finance, CMBS has historically been the first to retract and last to return in Europe when markets are turbulent. So I think unfortunate is the word that I choose to use. And I use that because 2021 and Q1 2022 were very strong. We had kind of a record volume of deals post the financial crisis, different types of loan collateral, service stations like science, cold storage. We were seeing a slightly deeper investor base. Many deals went out as 144A, so there were US investors involved as well. We saw some larger deals come back, so Taurus 2021-4, which the market managed to absorb. And we also saw the first CRE CLO and a couple of granular small balance deals. So things were looking pretty good. Now the market is effectively frozen for the reasons laid out earlier, and that's generally because there's a discrepancy between the loan margins that kind of closed in early 2022 and current note spreads that are in the market. But the CMBS fundamentals actually look pretty good. 2021 deals generally had moderate day one leverage. They tend to go out with between the day one LTVs of 60 to 65%. Income coverage was actually quite strong. Most of the borrowers were hedged with caps at strike rates of below 2% and under. And performance has been stable. We've been affirming the bulk of the deals we've reviewed, even managed to upgrade one due to significant paydowns. And the noise we're hearing from servicers as well kind of echoes that. They're not expecting a lot of loans to start defaulting and move into special servicing anytime soon. So that said, we are living in a rising interest rate environment. So at the moment, we're looking to see when and if rising interest rates will lead to rising cap rates. But that said, our analysis is through the cycle. So we still feel at the moment we have an adequate buffer in place. Looking ahead, I think participants are just patiently waiting for the economics to start working again. So for the loan and the note spreads to realign. But when they do, I think there will be a strong bounce back, just as we saw post-COVID lockdown, because there does seem to be a lot of investor appetite for CMBS and also CRE CLOs in the future.
Great. Thank you very much. Thank you very much, everyone. I guess to summarize, what I would say is that there are some challenges ahead, and the overall feeling was that there was an acknowledgement that there is some disruption in the market and there are some challenges ahead, but overall, people still constructive on moving forward, and not really a sense of panic per se, but more a face of caution until things have settled, and then people still ready to be productive in the securitization market. So I would take that as a moderately positive sign, especially given the disruption that we are currently facing. If you would like to learn more information about what happened at the conference, we have put together a summary for each of the days of the conference, day 1, 2, and 3, which can be found on KBRA.com. Please do take a look. We also have, as I said, the survey, which was published before the conference, and we have the CLO report. Plus, there is also, in addition, a more specific piece that is focused on Irish RMBS and the current situation there. So please do take a look on KBRA.com. Thank you very much for listening. We look forward to bringing you more conversations in European credit, and we wish you all a prosperous rest of 2022, and we will speak to you again soon. Thank you.